And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Yes, it's Monday, getting ready to wrap up the month of April. So next trading over the next couple of days could be a little bit anywhere as we kind of wrap up the month. But again, we're not at the end of the quarter, so it's no big deal. About to kick off the month of May. So here's how this works seasonally as we move into the summer, because again, this is a presidential election year. We've talked about this before. So the month of May tends to be a little bit weaker, right, than normal. It's got a positive return, but not much of one. June, July, and August in election years tend to be better. So again, we could see a little bit of this kind of sloppiness we've seen in the markets over the last couple of weeks, see that continue for a couple more weeks into May. But again, once we get to June, July, August, those tend to be better during presidential election years. The correction normally comes in September and October, just prior to the election. Again, this kind of makes sense. Wall Street, kind of uncertain about who's going to get elected, particularly this year. It's going to be a highly contentious election. Whoever wins, there's going to be claims of cheating and whatever else on whoever wins the election. So it's just going to be potential there for some outlying risk that Wall Street probably doesn't want to deal with. So again, you typically see some selling going into the election because you just don't know what policies are going to be, right? You know what policies you're going to have with the incumbent, right? But you don't know what the policies are actually going to be with the challenger. And if he gets elected, then you're not quite sure what you're going to get. So Wall Street tends to sell off a little bit heading into the election, just kind of hedging off that uncertainty of the election. And then after the election, you go, okay, now I know who's elected. I know what the policies are probably going to be, tax cuts, tax hikes, whatever it is, and then invest accordingly. Markets tend to do better in November, December following the election. So again, that's kind of the roadmap for the rest of this year. Does the market play out that way specifically or exactly? Of course not, right? Markets tend to do their own thing, but that's kind of what you should expect here a little bit. And we'll talk a little bit in just a minute when we do our Before the Bell commentary about where we are currently in this correction process that we had talked about, back in February and mid-March. So that's coming. So this week also very important because we have the FOMC meeting. That's a 2-day meeting that starts on Tuesday, finishes up on Wednesday, which means Mike and I will talk about it on Thursday. But all eyes on Jerome Powell. Will he, won't he, might he, will he cut rates, right? That's the big question. Is the Fed now going to hold pat with some of the recent inflation data? Will they hold pat on cutting rates? But more importantly, will they talk about potentially hiking rates, right? Is this inflation data that everybody's been talking about here over the last couple of weeks, kind of ad nauseum, is it really putting the Fed at risk here of needing to hike rates, or will they just hold rates where they are for longer, as we go through that? But again, what we'll get is some real hints from Jerome Powell on Wednesday when he does his commentary. We'll talk about it on Thursday. But we suspect that, the Fed's not going to do anything with rates at this meeting. They will probably talk about potentially needing to hold rates here for a little bit longer, maybe push the expectation from a rate cut in July, maybe out to September, still keeping 3 rate cuts potential on the table. That's kind of the outlook for this meeting. So again, still 3 rate cuts this year, but later in the year as the lag effect from housing starts to catch up with inflation and we start getting softer inflation prints starting in the next month or so. So again, that's going to be the big move this week in terms of the news. We do have some economic data out this week. We'll have CPI as well. So again, the employment report on Friday as well, because we'll be into the month of May. So on Friday, we'll have the jobs report. The Fed will already have this data. So whether or not the jobs report is strong or weak, the Fed will already know it at their meeting. So again, that'll already be factored in to the Fed's decision. I would expect a fairly strong employment number. If we take a look at the recent PCE expenditures that we saw last week, still suggests that the economy remains strong. We still have a lot of immigration coming into the country. That's creating, as we in our recent report, we covered the impact of immigration on employment. So again, the employment numbers likely to remain fairly strong. Unemployment low. Again, real no threat right now of a recession, really kind of on any front. In fact, as of that PCE report on Friday on the personal consumption expenditures, the Atlanta Fed has now pegged Q2 GDP at 4% growth. Of course, we just printed 1.6 in the first quarter. So again, fairly strong economy, real no sign of recession. Okay, here's what you need to know before the bell this morning. So on Thursday and Friday last week, nice rally on Friday on that PCE report. Remember, we had that strong report that came out on Friday suggests that the economy is doing very well. And of course, we also had those boomer earnings reports from Microsoft and Google. Google announcing, of course, not only really good results, but also a $70 billion buyback and a dividend. So that stock up 10% on Friday as well. So again, very strong earnings from tech companies pushed the index up to the 50-day moving average where we are currently testing that today. So here's kind of the important breakdown. If we take a little bit closer look here, the market's doing well here. And again, as we talked about, we had this correction. We came down, tested the 100-day moving average, found support, rallied a bit towards the 50-day, failed. So that was kind of a failed test of the 50-day moving average. Came down, almost retested the 100-day, so you had this correction. Strong move on Friday, actually testing that 50-day now. So, in theory, we're starting to build a little bit of a trend in the market. We've got some higher lows here that occurred between last week, set a little bit higher high than where the market turned back lower on Wednesday. So again, we've got a kind of a bit of a bullish trend starting to build here. So if we can break out above this 50-day, 20-day moving average convergence, if we do that today, futures right now pointing higher. NASDAQ's up about 50 points. S&P's up about 9-10 this morning. So again, if we can break above that, the market has a shot here at retesting these previous highs. So we'll see kind of what happens. If the market fails today, we're going to retest this 100-day. So again, we're kind of in limbo here at just kind of this point right now. We're still in earnings season this week. We've got Apple, lots of other major companies. We'll have about 80% of the S&P fully reported by this Friday. So it's going to be a very busy earnings week in terms of the market. So again, kind of market can move anywhere. But really this kind of key look right now is that we want to break above this moving average convergence. If we can do that, then the market's going to be able to move a little bit higher here, retest these previous highs that we had set back in March, retest those highs. Again, but though a failure here, we're going to retest that 100-day, which is going to be really critical support. If we break that 100-day, we've got a bigger correction ahead of us. And that is certainly possible. Don't want to say that's not possible. But again, it looks like we're starting to build a bit of a consolidation. It looks like we may have bottomed here. The MACD is starting to turn up. If we can get that to cross into a buy signal, that's going to be very supportive of the markets. Markets are not entirely overbought yet either. So again, there's still some room here for the markets to move higher. Again, not a lot of reason. This correction was needed. We were really overbought, really extended, really deviated, needed that bit of a pullback here. We got that. So again, now it looks like we're kind of back in trend of this market, at least for now. July, August coming up, potentially stronger. Get ready for that correction. That we have one more correction here before the election. So again, it's going to be interesting to kind of watch the market, see where we go to from here. But that's what you need to know before the bell this morning. When we come back, lots of stuff to get into. We'll go through all of it this morning right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, in January and February, we were talking about the need for a correction, and that the market had gotten very far ahead of itself on this whole AI trade thing, and stocks were overbought, needed a bit of a pullback, which again wasn't surprising. It's healthy, it's needed, but as is always the case, right? Kind of in the heat of the moment when markets are going up, everybody's super exuberant. This time's different. It's the can't stop, won't stop bull markets. I'm just making money hand over fist. So when the correction comes, it's always traumatic, shall you say, and it's always larger than what people kind of expect. And it's like, okay, if the market's down half a point, that's fine. But, anything more than that, it's tragedy. And it's always interesting because when the correction comes, then I start getting a lot of emails about, we got to, why aren't we hedging this and hedging that and shorting the markets and doing all this? Because, and again, we haven't had that big of a correction, right? And we don't really expect that big of a correction. It's just 3-4%. Total drawdown from peak to trough was 5.5%. It's not that big of a deal. And, we'd taken profits in some stocks earlier before the election occurred, the correction occurred. And so there wasn't a tremendous amount of work to do. And we said, look, when this correction comes, use that as an opportunity to add to positions that you've been wanting to buy for your portfolio, et cetera. And again, it's that. But there's always this, and as we said, when the correction comes, it's going to feel worse than it actually is because we'd gone such a long stretch since November without really having a correction of any sort. Then any drawdown is painful, right? It's like every day the market just goes up. That's easy, right? And then when the market goes down, all of a sudden it's not fun anymore. And that's just part of the market cycle, right? That's just the way things occur. But of course, I start getting a lot of emails about, it's the inflation, it's interest rates, and, this is going to, the market's going to go down from here. And the bull market, I saw an article written, the bull market's over, right? The bull market that started in November of 2023 is now over, and, we're on to the next bear. Maybe. Right? I'm not ever saying that something can't happen, right? But we have to keep some things in context. So I wrote a little bit this weekend about a couple of things that are going to be supportive of the markets in the near term. And as always is the case, it's important to understand the difference between a correction, a consolidation, and a bear market. And right now, there's not really the case for a bear market. Now, first of all, sentiment was extremely extended. So if we take a look at the composite index of both retail and professional investors, in mid-March, this is when we were writing about the need for a correction. Sentiment was extremely bullish. It went from 38.15 to 9 in 2 weeks, right? That's a very, very sharp drop in sentiment. And basically that drop was akin to the same drop that we saw last summer where we went through that 10% correction. So certainly doesn't mean that sentiment can't get a little bit worse from here. It certainly can. But again, that big reversal in bullish sentiment is certainly supportive of, giving the market the ability to bounce here a bit, and which is kind of what we saw last week. So again, it's just always kind of keeping, this idea in mind that markets are a reflection of psychology more than anything else. And, as we said, buyers live higher. And when markets are going up, buyers have to keep paying up to get sellers to sell. But when markets turn down, and we saw this over the last couple of weeks, there were no buyers. And so the market fell pretty quickly trying to find a buyer, and they found some buyers at the 100-day moving average. So again, that's just how markets work. Buyers live higher, sellers live lower. Sellers live higher, buyers live lower. And that's, kind of just the premise of the overall market. So, also though, a lot of people, again, these emails, being concerned that this was the start of a bear market. We needed to, start shorting the markets and those type of things. The volatility index never suggested there was anything more than just a normal correction. Yes, volatility picked up a little bit, but not significantly, not anything that was coincident of a bigger drawdown in the markets. So again, this kind of correction we had, very kind of normal at this point for a corrective cycle. And as we said, we wrote many times and talked about it here on the show that a 5 to 10% correction should be expected. And we had 5.5% so far. Now, could it go to 10? Sure. But so far, it's been about a 5.5% correction. And again, today we're going to kind of challenge the first test. This is the first test today of whether or not the current correction is over and we're starting to resume the bull market, or if we've got some more consolidation work to do. We'll see how the day ends, but that's where we are. But volatility certainly doesn't suggest that there's any big risk to the markets. So two things, though, that are coming up that suggest, at least for right now, that we are likely not going to have a much deeper correction. Again, we could go down and retest the 100-day, potentially go a little bit lower, but there's a couple of things that are coming up that suggest that markets are going to stabilize somewhere around here. So we've probably seen a bulk of the correction so far. Yes, it could be more, but we've probably seen a bulk of that. And one of that is just liquidity. So one of the things that coincided with the sell-off in the market was a drastic drop in liquidity index, and that was because of the change in the TGA. Over the course of the next couple of weeks, the TGA is about to provide liquidity back into the economy. And the reason is that we just had tax collections. So everybody just, and there's been a few headlines out about the big drawdown in money market funds. And that was people paying taxes. Well, that money now flows into the Treasury general account. So now they have about $1 trillion worth of liquidity that they can use for spending. So in other words, that means less debt issuance to fund current spending. So that liquidity is going to come back into the economy through government spending. So all the spending programs and everything. So now we've got this big chunk of tax collections. This will happen again in October. But that potentially serves as a quasi support for the markets, kind of like quantitative easing does. And if you notice, whenever, go back to that chart real quick. Whenever you'll notice that whenever there's a big spike in the TGA account, that typically aligns with market bottoms. And then as that spike starts to reverse, then markets are climbing. So again, that's just kind of one facet, that there's a liquidity event available for markets. The second thing, and more important, and again, as Google announced during their earnings report, is buybacks. The buyback window for corporations, that blackout period is ending as of this week. And so once we get into May, once we get past this week and Apple and everybody else has announced, that buyback window is going to open back up. And so the recent correction wasn't surprising, because with that correction that coincided. This was one of the things we pointed out. In fact, we wrote an article called "The Buyback Blackouts Could Lead to This Correction." We had about a $387 billion drawdown in buybacks over the last 4 weeks, and that aligned with this current correction. So those buybacks are about to open. That window is about to open back up, and there's more than and now along with Google, there's more than $1 trillion worth of buybacks to do. Because again, Google just added 70 billion to it. So lots of potential buybacks this year. Of course, that is a direct support for markets, as we've talked about before. Corporate buybacks are boosted really by two factors, and one is earnings growth. And as earnings improve, which they are, we're continuing to see earnings growth right now. As earnings improve, then buybacks tend to grow with those earnings improvements. Now, the reason for that is that improving earnings is a boost to CEO confidence. So who benefits from share buybacks? Not shareholders. Insiders of corporations benefit from buybacks. So as earnings improve, corporate executives want to do more buybacks because it's a use of capital that benefits them directly. They can basically sell their shares back to the company. So as earnings improve, the outlook improves, CEO confidence improves, and subsequently there's a very high correlation between the annual rate of change of buybacks and CEO confidence. So with improving CEO confidence and improving earnings, we're going to continue to see buybacks flow, which has been 100 since 2000. Buybacks have equated to essentially 100% of the net purchases of the market. So that's going to be a big driver for stocks, at least a support for stocks here in the near term. And those two things alone, the excess liquidity in the TGA account and buybacks, are likely going to keep this market from devolving into a bigger correction near term, which is why we just talked about, rebalancing risk, taking some profits here, buying into opportunities, as you see fit, because that will give you the ability at this point just to kind of weather this correction. But there wasn't really a need to short the markets because we didn't really have the setup for a short. And the problem with a short is there's nothing wrong with it. The problem with trying to short this current market is that it doesn't give you a lot of wiggle room. So you can quickly add a short to hedge your longs and then wind up negative on your short, right? And so because this market turns so quickly. So again, it's one of those things, we don't have a negative trend in place yet to really warrant shorting too much, but we can also hedge just by trimming exposure and raising a little bit of cash. But again, we still have some tests ahead of us today with this 50-day moving average, so we'll see how this works out today, and we'll talk about it more tomorrow. When we come back, I'm going to talk about retail sales a bit from last week, because very interesting data in that retail sales report that suggests the economy is not really as strong as it may appear. Talk about that next, right here on the Real Investment Show.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Part of the problem of the average American is that we've just chosen to live well beyond our means.
Basically, you can buy anything you want out there on a payment. You need new underwear? Go get it on a payment plan.
Underwear can be expensive. If you buy some Jimmy John's, they're not cheap.
Jimmy John's.
And
Sandwich
the point
underwear?
is,
What is this?
But Tommy John's, thank you.
The Real Investment Show podcast
That's why I just don't wear underwear. It's too expensive anymore.
at realinvestmentadvice.com.
Going commando is going to become a new thing for the poor people.
It's going to be a...
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, on Friday, I wrote an article. We recently had the retail sales report for March that came out. And we also revised, in March, we revised the February retail data higher. And everybody's like, inflation, this is all part of the problem, etc. But it was a very good report. On the surface, it was a very good report. And certainly kind of fueled the outlook for stronger optimism on the economy and spending, the consumer, all that. The problem, though, is the devil's always in the details. And so on Friday, I wrote an article talking about the retail sales, and I thought I'd go with you through it with you today because I've gotten a lot of emails about that retail sales report. It was interesting, though, when that report came out, the retail sales report came out at the same time the Wall Street Journal economic forecast came out. And Wall Street Journal has a bevy of economists that they go to and say, what's your outlook for a recession? Some other things, but primarily a recession. And that dropped to one of the lowest levels that we've seen. It was at 29. So the economists only give it a 29% chance right now of the U.S. going into a recession. We'll come back to this chart in a minute. But let's talk about the retail sales. So nominal sales, right, was very strong. They were up about 0.72%. February was revised higher at almost 9%. So clearly, super strong sales, nominal retail sales in February and March. So everybody's all excited about that. Well, so first of all, just a quick look. The prior 4 months were extremely weak, right? So let's talk about the prior 4 months real quick. October, November, December. October is your second largest shopping day of the year. Thanksgiving in November, Christmas in December. And you had very, very weak retail sales during those months going into January. So certainly suggesting that the retail consumer had slowed down considerably in the last quarter was all things. There's a point to where people just have to buy stuff. You can cut back for so long, but eventually you're just going to have to go buy some stuff, whatever it is. So you kind of a bit of revenge spending in February and March. Now, two things happened in February and March. First of all, you had Valentine's Day in February, another big spending day. And it's one of those kind of forced spending days because all men know if you don't spend on Valentine's Day, you may not see the end of March. So a lot of spending in February for Valentine's Day. Now, March was a much more interesting question because March had two spending periods in it, where it normally only has one. Spring break, where a lot of people go to travel. College students are out traveling. Parents are taking their kids out of school to go travel somewhere for spring break, whatever it is. So a lot of traveling, a lot of spending during spring break. And then Easter, because of calendar events, got pulled back into March. Normally Easter's in April. So you had all the spending and travel for Easter all occurring in the same month. And yet the nominal sales in March was weaker than February, which only had Valentine's Day in it. Now, again, this is nominal. This is not inflation adjusted. We'll apply some inflation into this in just a second because this is what's going on. But one of the big reasons why nominal retail sales was higher in February and March was because of the rise in oil prices. There's a very high correlation between oil prices and nominal retail sales because of gasoline, right? So it just costs you more to travel. So it's not surprising. And when you see the rate of change in oil prices going up, you see a pickup in retail sales because retail sales, if I go to the gas station and I buy gasoline, that's counted as retail sales. Now, here's the important thing about that. And this is particularly relates back to the inflation issue. Look, my truck, I drive a 2019 Toyota 4Runner, right, that I bought used. It only holds a certain number of gallons of gas. And I don't drive that far, so I literally fill up every 2 weeks. So every 2 weeks, I spend almost exactly the same amount of money on gasoline, assuming the price doesn't change. Okay? So if gas is $3 a gallon, $3.50 a gallon, $4 a gallon, whatever it is, from 1 week to, from 2 weeks to 2 weeks, if I go to fill up, if the price hasn't changed, I'm going to spend exactly the same amount of money on gasoline that I spent 2 weeks prior. If the price of gasoline has gone up, I spend more. The gas station registers that price change as me spending more money, but I didn't buy any more product. I bought the same exact amount of gas. I just spent more for it. Right? And this is the point about inflation. So if we look at inflation-adjusted sales, it's a vastly different look. And in fact, over the course of the last several months, retail sales haven't done much due to inflation. In other words, we're not spending a whole bunch more money. We're just not able to buy as much because it's costing us more. So it looks like on the surface that retail sales are doing fantastic, but in actuality, they're not. And so this really has a big issue relative to economic growth. And so right now we see some pretty strong rates of economic growth. And this is not uncommon because normally with economic growth is fine until it's not. And this is one of the big issues. If we go back in history, and I went back to 1956, I looked at every period prior to a recession. And in almost every case, GDP was growing at above 2% before the next month when a recession started. So when you're looking at GDP and go, well, GDP is really strong, there's no chance of a recession, that really doesn't tell you a lot because of the revisions that occur to the data. And let's go back to that chart of the Wall Street economist expectations of a recession. So Wall Street Journal, the economists say there's only a 29% chance of a recession. Well, if we go back and look at where they were previously, they never really expected a recession. And then a recession started. And the reason is because by the time that they realized that there's a recession, we're already well into one. Again, I'm not saying we're in one now. I'm just saying that the reliability of these forecasts are very low. And we have to look through the data to really see kind of what's going on in the actual real economy. And currently, everything seems to be okay. But that doesn't necessarily rule out the potential for a recession at some point in the future, because there's certainly things that are impacting the consumer. We just saw the PCE report, right? Consumers are spending a lot of money. That's great. But they're drawing savings down rapidly. They're going into credit. They're going into buy now, pay later programs, et cetera, just to make ends meet. They're not just going on a wild spending spree, buying everything in sight. They're just trying to make ends meet because of higher prices. And again, this goes back to our inflation conversation, is that, inflation will come down, but that doesn't mean the consumer will stop paying higher prices. And the reason for that is the way that we measure inflation over time. And because if eggs are $4 a carton, right now $4 a dozen or whatever for eggs, that's certainly much higher than it was a year ago when we were paying $2 a carton for eggs. So yeah, huge amount of inflation. Prices are higher. That's what the consumers deal with. And this is always the angst of consumers, because the reports come out saying inflation was coming down, and it's like, well, have you been to the store lately? Well, yeah, I've been to the store. But that's not the way we measure inflation. In a year, if eggs are still $4 a carton, inflation will be zero. But your prices didn't come down. You're still spending $4 for a carton of eggs when you used to pay $2, and it's really eating into the family budget. But inflation will be zero on a carton of eggs. And that's the way we measure inflation. So it's important to keep that in mind. But back to retail sales real quick. If we look at inflation-adjusted retail sales, what we find is that retail sales are growing at a very slow rate relative to economic history. And we're kind of currently running at levels that have normally been warning signs of a much weaker economy. So again, this is something that the Fed has talked about, something that we've talked about before, is that high interest rates are impacting economic growth. It doesn't seem like it right now, but we just haven't had the catch up yet of that lag effect of what's going on because of the excess savings we had, but that's going away. All right, quick break. We're going to come back. We'll wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, sometimes truth is stranger than fiction. And so lately, just trying to find something to watch, my wife and I have been just kind of rewatching some old movies. And, so some of these are, kind of the futuristic stories of what people thought. So in I think it was like 2009, 2010, something like that, they made a movie called Children of Men, talking about the future. And by 2027, right, the world's in disaster and people have stopped having babies altogether. So the future is doomed because there's no next generation. And, and what's interesting about this is when you kind of watch the movie is how quickly the world devolves into anarchy. Not that anything's going on, right? But that in the next generation or two, there'll be no people left, right? Because nobody's having children. And so the world's just gone into complete anarchy. And I told you we had watched this Netflix series called The Three Body Problem. And if you haven't watched it yet, I won't give away the plot, but there's something that's going to happen in 400 years. And because of that, 400 years from now, the world's in anarchy because of something that's going to happen 400 years away, right? So it's just how quickly that humans evolve and, or devolve, I should say, into their base instincts when there is no hope, right, of something. And so it's kind of the premise of a lot of these movies. And a lot of these, the Terminator and others have talked about, the future of where AI turns rogue on man and humanity. AI kind of become self-aware and they go, well, humans are really kind of pests. They're kind of insects, and we just need to get rid of them. We'll all be the planet will be better off. We're talking about climate change. AI will solve that by getting rid of the biggest CO2 emitters, which are humans, right? So the trees can handle it once you get rid of humans, no problem. But it's interesting. So there's a couple of articles out today. I was just kind of glancing through, and the two articles are completely different, but they all kind of home back to the same thing. One is on cargo shipping. And that the wave of the future for cargo shipping is to have artificial intelligence handle all of these cargo ships. And so basically there'll be no humans on board. You just load the ships up and they go to port and then we unload them on the other side, which will eventually be done by robots, which will have artificial intelligence that'll unload the ships and then reload the ships and send them back to where they're going. So it's all artificial intelligence. which is great until somebody hacks the AI, right? And, drives the ship into a bridge, or something like that, right? Takes out, critical infrastructure. And so on the back of that story, the EU is now beginning talks about the tank of the future after Russia has annihilated most of the Leopard 2 tanks in Ukraine. Now, you got to go back to World War II. At that time, Germany made the Panzer tanks, which just demolished everything else on the battlefield. They were just vastly superior. And so flash forward, Germany's now in talks with the EU to build the next generation tank to help combat, to increase its effectiveness on the battlefield after the Leopard 2 tanks just were wiped out. So it's not about, so this is the quote from German Defense Minister Boris Pistorius. He says, it's not about making the Leopard 3 or 4, it's about designing something brand new. Pistorius said the next-gen main battle tanks will be equipped with artificial intelligence and will not require human pilots. Go watch a movie of Terminator and see what happens when you equip all of your military with artificial intelligence. Drones, tanks, missiles, you name it. Just saying. We're not that far away from self-annihilation. It's just a function of time. Artificial intelligence will figure it out, right? But seriously, I do think this is interesting. We are starting to apply more and more artificial intelligence to everything that we do. And just when we talk about jobs, the economy, growth, sales, okay, great. We're going to build a new next-gen tank, and we'll no longer need tank pilots, right? So no longer need, soldiers and tanks to drive the tanks. That's a job. They make money. They spend money. No longer need to have anybody on ships. Ship captains make a lot of money. That's jobs we're not going to need anymore. Yes, the argument is, well, that'll give those people jobs somewhere else, right? So they're going to go program the artificial intelligence. Okay, how many people do you need to program artificial intelligence? Particularly once artificial intelligence learns to program itself. Because that's already happening. So at some point, artificial intelligence will be able to build the artificial intelligence it needs to complete whatever task that it wants to do, right? That'll be the eventual evolution of this, but that's a job that's displaced. So the question becomes, yes, the effectiveness of artificial intelligence is fantastic. It has a tremendous role in the future of our economy. And right now, there's just a huge surge, of course, in anything related to AI or AI infrastructure. So power, electric, anything like that, and data centers, et cetera. So those stocks are just going crazy right now on the potential future of AI. But the thing we have to think about in the future is the displacement of labor because of AI. Because again, for the economy to work, we have to produce something in order to get a paycheck, in order to spend. And we're already starting to see some of the effects of California. California raised their minimum wage to $20 an hour. A Chipotle bowl in California that'll cost you $17 in Nevada will cost you $35 in California because of the increase in the minimum wage. And we're seeing this with Chick-fil-A, McDonald's, et cetera, all raising their prices at least 10% to offset the higher costs of minimum wage. It's also cutting into the number of hours worked by the employees. It's also reducing the number of employees in general to offset the cost of the higher minimum wage. So how do I replace that labor? I automate services, right? I do self-checkout counters versus a manned counter. I use technology to my advantage. So the more AI I have, the more jobs I can displace because I can have those man robots, that AI man the robot that does the work. And the problem with AI is that it doesn't just stop at the low-end retail fast food workers. AI can replace programmers, lawyers, accountants, bankers, you name it. There's not doctors. There's not a job that AI can't do when programmed properly and given the right set of tools. So the implications economically, kind of forgetting the more dire outlook for, AI turning rogue at some point, is the impact on economic growth. And not so much in terms of economic growth, right? That's one thing. But economic prosperity is a different thing. We can still have economic growth, but we can have economic growth with a very much smaller middle class, a much larger lower end class, with more and more of the wealth being concentrated at the heights. That's the risk going forward. And look, this is something that's years in the making. We'll see this coming. The world will adapt. My question is just simply, what do all the people that are doing jobs now that will eventually be displaced by AI going to do? Are we all going to become programmers in the future? What does the world look like? And this is why I think there's a bit, the one thing that, at least for now, seems to be safe is trade, right? Electricians, plumbers, those type of things. But even AI will eventually affect those jobs as well. That's just a function of time. But again, I think that's why you're starting to see more and more of a push against, going to college and getting a degree and going back to trade schools. We're seeing more and more people starting to advocate trade schools as a potential source of post-high school graduation options. Anyway, I just think it's interesting, just, something to keep a watch on in terms of AI as we continue to kind of expand out from that. And, the big thing to really kind of watch as we get ready to kind of wrap up the show this morning, just keep a watch on the markets for right now. Again, this is all long-term stuff. It's fine. It's interesting to talk about, but what matters in the short term is what happens in the market. And right now, that's a very interesting picture, right? We're in the middle of this little correction here. We'll see kind of what happens. But again, just kind of pay attention to the day-to-day. That's much more important. Just try not to get wrapped up into the end of the world scenarios, at least in the short term. and we'll go from there. Okay, get by the website. Latest articles are out. The newsletter's out on the website. And, this is, everything's there. Send your questions and comments. If there's anything that we can do to help you, we're more than happy to help you. Of course, as always, answer your questions. So don't hesitate. Get to the website, realinvestmentadvice.com. Send us your questions, your comments, your emails. Let us know what we can do for you. And, of course, make sure and like and subscribe to the channel. We appreciate your support here. And as always, we'll see you back here tomorrow for the next edition of The Real Investment Show. Have a great day.